Good afternoon, everyone. I see everyone starting to come in. My name is Lauren Simpson. I'm with the SBDC, and I am joined today by my colleague, Mike DiDonato. Hello, sir.
Hi, how are you?
Doing good, thank you. And we should be joined by GB as well. I'm going to go ahead and take a couple of seconds while everyone comes in and share a bit about who we are and what we're doing here today. I did want to say that we are pleased to offer this event, so this session, through the Community Navigator program and the U.S. Pan-Asian American Chamber of Commerce. And I'll have some information related to that program via a link in just a bit. Ooh, that was fancy. Again, good afternoon, everyone. My name is Lauren Simpson, and I am with the SBDC, or the Small Business Development Center. We have 1,000 locations, over 1,000 locations across the country, and we offer no-cost services to local small businesses. And they are no cost to you because your tax dollars have already taken care of our fees. For the Los Angeles network, which is the network that I represent, we have locations throughout Los Angeles, Santa Barbara, and Ventura counties. And you can see those locations represented on the map in front of you. You'll see we're as far out as Santa Clarita, over to Pasadena, down to Long Beach. So if you're in any of those areas, please be sure to get in contact with us. Again, you'll want to do so because we offer no cost business advising. And so you're able to set up a one-on-one appointment with a business expert like Mike and our other colleagues from genres of marketing as well as taxes and finance. If you're trying to get your projections in order, if you are looking to create a business plan, we have free resources for you. And we also offer virtual trainings, much like the training you have joined today. So please be sure to get in contact with us. You can reach us via phone, 866-588-7232, or online, smallbizla.org/new client. And for those of you who have reached us outside of the Los Angeles area, you can go to americassbdc.org/find-your-SBDC. With that, I'm going to stop my screen share. Quick housekeeping, Mike. All questions, let's keep them on topic, please. On topic, and let's put those into the Q&A. The chat will be reserved for any links and items that Mike would like me to share with you. With that, I will hand it over to you, Mike. Good afternoon again.
Thank you, I appreciate it. And thanks for joining me, everybody, and Lauren. I'm going to cover briefly grants. I'm sure some of you have heard about the California Dream Fund, which is a grant program that we're running along with numerous other partners. You can get up to $5,000 or $10,000 depending upon your business, and there's a process by which you have to attend workshops and apply. And Lauren, perhaps you can put the link to our page in the chat room regarding the California Dream Fund. It's for startups. There are other sources for grants. I'm briefly going to touch upon them, and then I'm going to go into my presentation on small business contracting. So let me first share my screen. So we get a lot of questions regarding grants. And the first place you want to start with is grants.gov. Grants.gov is the federal portal that you can go to seek out grant opportunities. In order to obtain a grant through grants.gov, you need to first sign up through the System Award Manager, SAM. They used to have to get a DUNS number. Now, the US government, you can see on the screen, will establish its own unique identifier in order to apply for federal funding opportunities with grants.gov or through their contracting service, which is sam.gov. So it's one place to look for grants. The state of California has its own portal, which is grants.ca.gov. We can look for grants, okay? And then there's some other, I'm giving you a few resources here, there's many others. For example, I Fund Woman is a crowdfunding resource. It also has lots of information for grants for women-owned businesses and startups. There's numerous grants listed here, okay? All these grants are competitive. Don't assume just because you apply for a grant, you're gonna get it. You're not. You need to put forth an application that's going to be suitable and appropriate for the funding, and it's going to be very competitive. The Barstool Fund came about during the pandemic. It's for bars and restaurants, and you can see they raised over $41 million with 231,000 supporters. So if you're in the food industry, restaurant, bar, et cetera, you might consider applying for the Barstool Fund. And I'm only going to do a few of these, lots more. LASC, Local Initiatives Program, they contract with cities and other organizations to offer lots of grants. So this is another resource. So I'm going to stop there. I just want you to be aware there's numerous resources, and you can do a Google search for grants. Start with grants.gov, the California Grants Portal, and look for other opportunities. But remember, they're competitive, and as GB would tell you, they're taxable. So I'm going to stop that share, and I'm going to let GB jump on. Hi, GB.
How are you, sir?
Doing well. Thank you. Thanks for joining us.
Sorry to keep you waiting.
It's all good.
Ready to get started?
Yep. Let's go.
Perfect. Let me do the screen share. Can you see my screen?
Yeah. Oh, crypto taxation.
Crypto taxation.
Awesome. I love it. Yes.
Yes. There has been a lot of movement in basically all securities market, all real estate and all property market, but crypto has taken a nosedive, and a lot of people are wondering what is their tax exposure. This is a very common theme that I've been dealing with my clients over the last couple of days. So I figured this will be a high time to share with our attendees who may or may not have exposure to cryptocurrency, either directly or indirectly. At least if they don't, I know they know people who do. So at least our attendees will sound intelligent when they talk to friends and family, especially at the July 4th barbecue coming up. So that is the essence of today's presentation, cryptocurrency. Let's see. Okay. So first of all, when it comes to crypto, like any other mode of exchange, because IRS taxes any and all modes of exchange. Barter transaction, where if I give you a cow for a dozen eggs, is still considered a tax consequence. So first thing that we take a look at with a client is, how did the client come into the ownership of this cryptocurrency? And there are multiple sources. For example, some people have received cryptocurrency as a gift or maybe as a compensation for their job or contract work. A lot of people, even at one point, I'm not sure they're still doing this, but there was one point when people could buy a Tesla, not too long ago, just a few months back, could buy a Tesla using cryptocurrency. They stopped doing it after a few weeks, but depending upon if you are accepting cryptocurrency as a compensation for your employment or your contract work, if that's the case, it is considered to be ordinary income, no different than if somebody were to pay you in US dollars, in Mexican pesos, or in euros, or any other currency of the world. But especially if you came across it as a contractor, you may also have self-employment tax consequences on this crypto. So long before we figure out whether or not you're making money in cryptocurrency, if you have received a crypto as any and all sorts of compensation, you may have an immediate taxable liability long before you sell it at a loss or at a gain. Also, if you are a miner or a trader of the cryptocurrency, you have some other consequences that we'll talk about in a few minutes. No matter how you came across this cryptocurrency, whether you mined it, whether you traded for it, whether you bought it, whether somebody gave you a gift, whether somebody paid you a salary or gave you contract compensation, after we have dealt with the ordinary income, now we have to deal with, did you have any capital gain or capital loss or not from this exchange? And we'll talk about this consequence in a few minutes as well. Right now, this slide is just giving you a breadth and depth of the crypto taxation and how, unlike a regular contract where somebody pays you money, there are other consequences if you do transactions in crypto. Also, some of you may remember, if you bought and sold properties up until 2017, it was subject to like-kind exchange, where, for example, if you bought something and you sold it at a gain, but you bought something similar, maybe a car, maybe something, a real estate, you were considered to not pay taxes on that gain because you were exchanging one like-kind property for another. Starting in 2018, that was limited to only real estate. Prior to that, you could do with art, a barrel of wine, a car, anything. Cryptocurrency has been around 2009. We still come across some tax returns where some underinformed or undertrained CPA may have considered crypto transactions as like-kind exchange and not pay taxes on behalf of the taxpayer. If that's the case, sometimes, I mean, it's too late to amend some of those returns, but we may have to go back and make corrections on that, because I wanted our attendees to know cryptocurrency was never eligible for like-kind exchange. So if you or somebody you know in 2017 or before did like-kind exchange on crypto, you may want to proactively change those assertions, because IRS plans to crack down on it starting in 2023, which is just 6 months away. Also, if you don't know what hard fork and airdrop means, don't worry about it. But if you have participated in a hard fork or an airdrop of cryptocurrency, hard fork is non-taxable, airdrop is taxable. So if you don't know what that means, you probably didn't engage in it, so you don't have to worry about it. But if you did, hard fork is non-taxable more often than not. There are a few exceptions. Airdrop is taxable no matter what. Any questions before I go on? Anything from you, Mike, or anything from our attendees?
No, there's no questions, but not everybody understands what crypto is.
Yes.
You might want to cover that.
Sure.
Before
Actually, before I do, you
Yeah.
want to share your opinion on crypto before I chime in? Because I think it's good for the attendees to hear from both of us.
I'm not a fan of cryptocurrency because it's an unregulated marketplace. Our
Yes.
monetary system is regulated,
Correct.
right? We have taxes we have to get paid against this. The Federal Reserve controls the money supply, and there's all sorts of levers and controls in place. When you're in banks, I mean, heavy regulation for banks and other financial institutions, right? There is no regulation on cryptocurrency that I'm aware of, other than possibly the tax consequences.
You are absolutely right.
And that's my number one concern. So it's a huge risk.
It's a very valid concern, because a lot of people fantasize anonymity. A lot of people fantasize no government control. And to some degree, there is validity in that desire. However, I always remind my clients who are very passionate in one direction or another when it comes to crypto, I always remind them that up until just 100 years ago, 1907, there was no Federal Reserve Bank. There was no SEC. There were none of these institutions that we rely on today to correct somebody's wrongdoing. Prior to the SEC, stock market manipulation was rampant because there was nobody to monitor it. And people, this is why the Great Depression happened. And people it was a buyer beware of a mindset that, hey, if you buy something, you didn't do your due diligence, sucker, sucks to be you. And prior to the 1907, the Federal Reserve establishment, currencies were basically unregulated. A lot of people don't know that checks came into being because prior to the regulation of the currency, every bank had its own currency. So imagine in today's world where Wells Fargo has its own currency, Bank of America, its own, Chase, Citibank, its own currency. So when the US government said, all right, enough is enough, we're under the US Constitution, we're going to establish the mint and the treasury under the federal jurisdiction, banks were upset. And this is why they established checks, because what is a check? It's a currency native to each bank. If somebody gives you a Wells Fargo check, you deposit in your Bank of America, yeah, you may get immediate credit, but if it's a big enough check, they will put a hold on your account. That, all right, we want to make sure this check from Wells Fargo that you're depositing in Bank of America. Once that check goes to the Federal Reserve, goes to the Wells Fargo, if it clears, then we'll make the funds available to you. But we don't know this check from Wells Fargo, if it is good or not. That's the basic history of checks. And the other example I use with my clients is, imagine playing football. If you're just playing football for fun over the weekend, no rules, you can do whatever you want and have fun with it. Drink a couple of beers and get on the field. But we expect rules when we're watching professional football, because we want to know that the rules are fair for our team. And if the other team violates that, we get the extra yardage or maybe an extra point, whatever the heck we're looking for, we get that. So rules in itself are not bad. And this is what crypto was a wild west for a long time, since 2009. But starting in 2014, the tax rules are clamping down worldwide. And starting in 2023, rules will be even more regulated, because as of right now, any bunch of people can come together anonymously, have a bunch of servers on which they are doing certain agreed upon transactions, which is, I'm using a very simplified version, which is considered mining for these tokens. And once those agreements are established, a digital currency is created, and then people buy and sell those digital currencies. That is crypto in a nutshell. It's no different than somebody going to the mint and taking a piece of metal and minting coins, or going to the treasury and printing money. I mean, at the end of the day, it's called a fiat currency because it's just a piece of paper. And we have seen what some of us remember from our history books. Germany, people were carting a wheelbarrow full of cash when the German economy collapsed. No regulation, it just collapsed. And people had to take a wheelbarrow of money just to buy a pint of beer or a loaf of bread. So crypto is no different in that regard. And in the long run, for crypto to have any sort of validity or legitimacy, it will need to be regulated. And at that point, it will lose its original luster of anonymity and, hey, I can do whatever I want without the regulation of the government. Unfortunately, if you're dealing in the dark world, the dark web or something, you're doing illegal things, they will accept anything. I mean, human beings are also bought and sold, even in this day and age, as currency in the dark world. It's an unfortunate, sad truth of our society, even just a few miles from where many of us live. But in the real world, we have rules and regulations about from using people as property, and crypto is no different. So it's a long answer to your inquiry, but crypto is basically an agreement between two people assigning value to something initially. It's an arbitrary thing. This is worth X. And then over time, if people buy and sell that currency, it raises or drops in value, just like a stock price. People want to buy more and more of Amazon and Tesla, it goes up. So did that make sense, Mike?
Yes, makes absolute sense. Thanks for that. Appreciate it. And one other point, what can you do with it? If it's not generally accepted, you can't pay your rent with it, as a practical example, unless the landlord accepts rent payments in crypto. How many people are going to do that?
Exactly.
Yes, Tesla did accept crypto on point.
For a time being.
So currency is a form of exchange. I can't buy groceries with crypto, not that I'm aware of.
Yeah.
Okay. So until it's generally accepted into the marketplaces, and that's going to take a long time because it's unregulated, there's a lot of risk associated with it. It's speculation.
You bring up a great point, because at some point when it will be widely accepted, the challenge is most people have a very different risk profile. So some people enjoy a sports car because they want to go fast. And some people, I mean, I have clients who will not go over 65. For them, a sports car is a waste of money. So everybody has a different risk tolerance. This is why the society imposes 65 miles per hour on the freeway. Can your car do 120, 140 safely? Yes. But somebody driving a slower car, an older car, may be put at risk. So to average out the risk, regulation kicks in. So you're absolutely right. When the day will come, you can buy a loaf of bread with crypto, or you can pay rent with crypto. it will have to be regulated. And then it will just lose its original intent, just like anything else. So,
Right.
so we talked about source of income, and I hope a lot of people now understand what crypto is. So now let's talk about something else that is related but very different, the NFT, non-fungible token. Unlike a crypto, which is not even a currency, the IRS has specifically stated that NFTs are property, not currency, because by definition, currency is regulated. So it's a digital property in the form of an artwork. It could be a video file, an audio file, or something else. It is just, like to say, the art is in the eye of the beholder. If somebody looks at graffiti, some see it as a nuisance, some see it as an expression of art. You go to any museum, some people love it. They can spend hours staring at a painting, and some like, all right, seen it, next. So because it is classified as a property, not a currency, starting in 2023, starting January 1st, 2023, if people are trading in NFTs, it will be subject to Form 8300 reporting. Some of you may know, if you ever go to your bank and deposit $10,000 or more in cash, they ask you, all right, we don't know where this money came from. Fill out a special form where they inform the IRS that somebody walked in with $10,000 in cash and made a deposit. And those rules were even expanded a few years back, where people used to do that, okay, I'll go deposit 2,000, 2,000, 2,000 in different branches. Now they look at the aggregate amount within a certain time period. And different banks are also interconnected, because if you are just going around depositing cash in different accounts in different banks, they look at the metadata and they can track it. So starting in 2023, if you are dealing in NFTs, you may be subject to the Form 8300 requirement. And if you engage in a transaction without filling out the form, it could be a private party transaction. If you engage in a transaction without the Form 8300 filing with the IRS, you may be in heap of trouble, because now you're also violating FinCEN, which is Financial Crime Enforcement Network. You could be in a heap of trouble beyond just tax compliance. So I'm not trying to discourage, given my introduction and given these things, my goal here is not to discourage anyone from participating in the NFT or the crypto market. My goal here is simply to inform you that if you do, rules are changing almost on a quarterly basis. So just to stay abreast on these rules, so that you're not still thinking it's a wild, wild west, I can do whatever and get away with it. Things have changed a lot since 2020. And things are expected to change dramatically in 2023 and beyond. As of right now, even though there is the upcoming requirement of Form 8300 filing, there is no formal definition of the NFT as of yet. Now, what exactly defined as the NFT? Overall, it is considered a digital property, not a currency, but that is the extent of the definition by the IRS as of right now. If you are dealing in crypto and NFT transactions where because most NFTs can only be bought and sold using cryptocurrency. So if you are engaging in the NFT market, your compliance is multifold, because first of all, you have to figure out, where did you get the crypto from? Is it ordinary? Is it capital gains? Is it self-employment tax or not? All of those rules you have to comply with. Then you have to comply with when you bought and sold, because basically when you're exchanging crypto for NFT, there is a capital gain or loss exposure. So you have the ordinary income exposure for the same transaction and the capital gain or loss, short-term or long-term exposure. And then you may even be subject to inventory rules. So Mike and I, we have talked about people who are in the manufacturing or goods movement business, because IRS is treating NFTs as property. If they deem that you regularly trade in NFTs, you are running a business. And if you don't follow the inventory rules, they got you on that as well. So you have ordinary income exposure, you have capital gain exposure, and you also have inventory business rule exposures. So you can see that how they can grab you. The famous story I use, and I think I may have used it here too, Al Capone was a brilliant man. People have said about him that if Al Capone, some of you may not even know who Al Capone is, so pardon me, he's a well-known gangster from the 20s and 30s. If Al Capone had used his mind towards legitimate business activities, he could have built another General Motors or a huge corporation of equivalent. The man was brilliant, and he built an expansive mafia organization. FBI and all the other agencies of the day could not get him on any of those charges: racketeering, prostitution, drug trafficking, bootlegging, murder, all of those things. Finally, Al Capone went to prison because of tax evasion. This is why IRS has a special unit, big guns and helicopters and tanks and all. They come, I mean, NFT may or may not, unless you're in the dark web, may not happen. But the point being, a lot of IRS has tons of tools at their disposal to get you if they think you are not being proper in your dealings. So you can imagine just these are the three major rules. The inventory rule is something that a lot of people don't know about when it comes to NFTs. So be mindful of that. Anything you want to add to it, Mike, before I move on?
No, great explanation. Please continue.
Thank you, sir. This is why words and definitions are so key, because you may be thinking NFT is art because it's digital property. It opens up a whole slew of tax compliance. So beyond the property, is it a property or a security? Why? Because either one of these has very different tax rule implications when it comes to reporting. The default status of NFTs, especially, but even crypto, is it is a property. Now, this may also change starting in 2023. Right now, we have a lot of proposals from Biden and the Congress, and they're awaiting what happens also in the midterm elections, but we're expecting a lot of changes on this classification as well. Now, why is it important? The default status is it's a property, which means if it is a property, it is not subject to wash sale rules. What is a wash sale rule? You have something, you sell it, and if you buy it again within 30 days before the date of sale or after, any losses that you have are basically considered immaterial, which means maybe let's say you own Amazon stock, and let's say it's worth $1,000 a share. I'm using a random number. And let's say tomorrow the stock price drops to $800. You have a loss of $200 on paper. You haven't sold it yet, but let's say you sell it at $800. You have a $200 loss that you are allowed to deduct on your tax return. But within 30 days, if you buy that stock back, that $200 loss will be disallowed on your tax return ever. So that's a wash sale, because you are basically, the IRS is saying you are in no different position than if you had not sold it. Now, property is not subject to wash sale. So for example, a lot of our clients, when the crypto value drops, we tell them sell it and buy it immediately. Why? Because now you have booked those capital losses that you can deduct under different rules against your W-2 income, against your other capital gains, so on and so forth. So if it is, now as of right now, it is considered a property. Now, the challenge is this: if you're buying and selling crypto on Coinbase or Robinhood, they do sell some crypto-based assets. So if you're buying and selling those, you're thinking you're buying crypto, but you may be buying a security. If that's the case, now it is subject to wash sale rules. If you're buying and selling the actual currency, whether it's Dogecoin, whether it's Bitcoin, whether it's LTC, whatever you're buying and selling, if you're buying and selling the actual token or currency, then you are buying and selling a property. But if you're buying and selling something else, and this is what Coinbase and Robinhood did, they took a market that is a wild, wild west and try to bring some control to it to make it more palatable for the masses. The moment they did that, they also started engaging in some security. So I'm not telling you whether you have a security or you have a property. It is up to you to figure it out. And remember, wash sale, if you do if you are buying and selling the actual crypto, which is deemed to be a property, to make sure that you are not further subjected to the wash sale limits, you have to, if you get audited, you don't have to show this on your tax return, but if you ever get audited, you have to show that the wash sale that you engaged in was due to a true economic risk, not a tax dodge. So this is where there's a very fine line between tax planning and tax evasion. So wash sale rules are designed for tax planning purposes. But if you're buying and selling securities just so that you can book a bunch of capital losses so you can offset your gains from Amazon or from Tesla or anywhere else, IRS may still say, you know what, you did not have an economic substance in this transaction, and we will further disallow this wash sale loss. Also, now keep in mind, if you don't have any capital gains from anywhere, real estate, your own business, or other crypto, or whatever it may be, then your wash sale loss are limited to $3,000 per year, or $1,500 if you're doing married filing separately, but you have long time to recover those. So for example, if you have $21,000 worth of loss on crypto, for example, you may only deduct $3,000 this year. The remaining you can carry forward for 6 years to recover those losses against your ordinary income. So I'm going too much in detail, but the reason I am is because there's a lot of misinformation about crypto and wash sale out there on TikTok, on YouTube, on different websites. You want to consult a proper tax accountant before you use TurboTax to book these losses or gains on your tax return, because whatever you will put on there, IRS will hold you accountable for it. And if you don't know what you're doing, you may be in a heap of trouble, even to the point of financial crimes, which carries federal penitentiaries. So anything you want to add to that, Mike?
So this is in a situation when you're constantly buying and selling, basically an asset. You're buying and selling an asset, similar to buying and selling stock.
It could only be one time, because you may have bought something last year, and this year when the market dropped significantly, you may have sold it. And then a lot of people say, you know what, I've already booked the losses. Why not just buy it back? Because I want to still ride it.
Right.
Yeah.
But there's a difference between creators. So if
Yes.
you're creating NFTs, then it's still a business. You're selling.
Yes.
So you have to
Inventory.
record the profit and loss. Right. But you also have to record the profit and loss from the business.
Exactly. Exactly.
Right. So that's a different that's like running a business, like selling toys.
Yeah.
You're selling an asset.
Correct. And just
You're
like
selling
any other business, if you're only producing one NFT a year, it's just other income. But if you're doing it on a regular, and what is regular, it's at the discretion of the IRS. Because what I always remind my clients, in the court of law, you are presumed innocent until proven guilty. In the tax world, you're guilty, and you have to prove your innocence. So the IRS will say, you know what, you did 12 a year, you're a business. You didn't follow the inventory rules, and some of these NFTs go for crazy amounts of money. And to me, it's no different than a couple of years back, we had the Beanie Baby craze.
Yeah.
I mean, some of those Beanie, and there was also those Pokemon card craze a couple of years back. I mean, all these crazy ideas come up every now and then. It doesn't mean that the underlying property is wrong. I mean, Beanie Babies are a great toy, and those Pokemon cards are fun. But the moment when people start trading them at an inflationary price, that's when trouble brews.
Right. As they're created, though, you have expenses associated with creating these NFTs, just like you're creating any other product. So appropriately record your expenses as if it's a real business.
Correct. And this is where you're right. You have to record what is your actual cost of goods sold and what are your other expenses. Because if you don't properly do so, you could be in a heap of trouble, because inventory rules, a lot of people don't understand. Inventory rules means like, while you're holding on to the NFT, if there's any cost that you want to deduct, you may not be able to until the NFT is sold
Sold.
So because
Right.
until then, it is just part of your inventory. So if you are taking deductions that you shouldn't be, that you should be capitalizing under inventory rules, you just filed a fraudulent tax return. So this is
Right,
where
but
you
then-
have the income tax compliance and the financial rules compliance.
Right, but there are other expenses you could possibly deduct associated with the running of the business,
Exactly.
such as the software that you need in order to create the NFTs.
Correct. And see, even there, the software, if it's SaaS, which is software as a service that you're paying a subscription every single month, you can deduct it. But if
Right.
it's a software that you buy that you're going to hold on to, now you have to depreciate that software. And California has different depreciation rules than IRS does. So even if you're buying a software, depending upon the nature of the software, will determine if it is capitalized and depreciated or if it is expensed.
Right.
So these
Great.
are all the
Please
different
continue.
rules that I want the attendees to be aware of as you
Right.
go about this business. And this is where it comes to the accounting method. Even if you are not deemed to be running a business because you're dealing in something that is deemed to be a property, you have to understand the accounting method. The default accounting method ascribed to crypto and NFTs is FIFO, first in, first out. You bought a piece of crypto or a token of crypto in 2009 or 2010, 11, 12, 13, so on and so forth. What you bought first, you are deemed to be considered to be selling it first. However, there are other accounting methods. Another most common one that a lot of my clients like to engage in is HIFO, high in, first out, because they want to minimize their capital gains if they have any on these NFTs or these cryptos. If you are using any accounting method, HIFO, or there's actually 6 other flavors, if you're using any accounting method which is different than FIFO, you have to, either you or somebody on your behalf, maybe your broker or your exchange, has to track what was the date and the time when this crypto or this NFT was purchased by you. What was the basis and the fair market value of this NFT or this crypto that was purchased by you? What was the date and the time when it was sold? And what was the fair market value when it was sold, exchanged, or disposed of? So this is a level of accounting that an auditor will ask for should you ever get audited. And if you are just, I had a whole 1-hour meeting with one of my clients who just have a few transactions, and he thought he can just report it on TurboTax. And in his case, TurboTax won't even let him do it because he didn't have enough information. And sometimes you can override TurboTax because it doesn't know, it's just a software. But if you ever get audited, they will ask for all of these records. And if you, your exchange, or your broker cannot provide this, they will disallow the deduction. They may also disallow and say, you know what, this is a short-term gain, not a long-term gain, which means you have to pay much higher in a tax bill, plus interest, plus penalties. So these are the things that you want to be aware of as you're doing your accounting. There are some good software out there that you have to pay for. I know Coinbase has its own version where they charge you $30 or $50 a month, which is a couple of $100 a year. But if you're engaging in this business, you need to keep proper records. You cannot be cheap. And it doesn't matter if your portfolio of crypto and NFTs is $1,000 or $10,000 or $1 million, the same level of accountability may be asked of you as somebody else who may be mining and hard forking for a couple of years. Anything you want to add to that, Mike?
No, treat this as if it's a real business. That's all I can say.
Exactly.
You know,
You are no
it's the
different
same
than a
concept.
currency trader or a property dealer or a
Right.
car dealer. You want to make big bucks? Guess what? Who else wants their cut? IRS in the state of California. And we haven't even talked about it, and we will not talk about this. There could also be some international rules compliance that many of these major nations are coming together and going to impose starting next year. So you may, if you are, for example, it was in news all over, the big company Celsius, based in Australia, froze everybody's account in the last 2 or 3 days because there was a run on the company. This is what used to happen. Some of you may remember from history books, banks used to have a bank run. People used to just, Farmers and Merchant Bank has quotations in Long Beach in their branches about the bank runs of 1907s and 1911s and the 1800s. It was a very common thing. And this is why people used to not trust banks, because they're like, hey, I'll keep my money under my mattress where I know it's safe. I mean, a robber may get to it, but I will not trust a bank because banks were not trusted before. They were regulated through the currency exchanges. So internationally also, Celsius, based in Australia, froze everybody's account. People who had hundreds and thousands of dollars worth of crypto, first of all, they lost value. And even when they tried to withdraw and sell it, they were unable to do so. People have put money based in crypto in their savings account. And a lot of people lost their life savings just this week because, hey, Celsius said, sorry, we cannot support the commitments that we made to you just last week. So be mindful. Again, my goal is not to dissuade you from engaging in the crypto or NFT market. My goal is to tell you the risks involved, the financial compliance, the accounting compliance, and the tax implications.
There was
Anything you want to add to that, Mike?
Yeah, there's a cryptocurrency came out called based on Squid Games, but it wasn't the Squid Game producers that came up with it. It went up quickly and then crashed, and all those people put money in it, lost it because it's unregulated.
Correct. And history is full of that. The Beanie Babies, the Tulip Mania.
Right.
I mean, we remember that, right? So people will buy and sell anything if they deem it to be valuable.
Right. And anyone can create a cryptocurrency now.
Anyone can create it. Yes.
If you have no way of knowing who they are. Yeah.
Exactly.
The software is out there.
That's the whole idea. I mean, the whole attraction, the crypto is the anonymity. But what comes with it, it's like buying a car. Like imagine buying a car and you have no idea whom you're buying it from. And if something goes wrong with that car, what are you going to do? I mean, you may get a great deal, but you don't know if the Lamborghini was stolen or not, right? So again, not to dissuade you, but just to forewarn you. If you are going to engage in the speculation, that's what it is right now. It's a speculation. It's deemed to be an investment. It's not an investment as of right now, because by definition, like imagine buying a house, forking over $1 million to somebody and not knowing, man, am I buying from the right person? Because somebody could take you $1 million and just walk. And now you have a debt mortgage. And this is why we use escrow companies, right? That I want to buy and sell a home. Escrow company like, all right, I want to make sure everything checks out. You are selling this property, right? Do you own this property? Do you owe money to anybody on this property? Are there any mechanic liens on this property? Imagine buying a house for $1 million and not knowing, having the unsettled feeling like, did I buy it from the right person? Or I don't know who this person was. They just say, hey, send me $1 million and I'll send you the keys in the mail. I got the keys. When I go and try to unlock the door, will it open or not? That's what we're dealing with here. So mark to market. If you are dealing as a business of cryptocurrencies or NFTs, one option available to you is as a trader to, even though you do not sell or buy your NFTs or your crypto at the end of the year, you may be able to treat, you could say, you know what, I bought this at $1, today's worth $1.50. So I just want to pay taxes and recognize that income. Now, some people say, why would I do that? There are reasons to do that. So talk to your tax advisor why you may want to do that. Or you may have bought something for $1. You don't want to sell it, but it's worth 80 cents. You can do mark to market at the end of the year and book ordinary income or loss on your tax return. Now, why is that important? Income, talk to your accountant, but for the loss, there is no $3,000 limit. Because you are considered a trader, you're running a business, you are following the inventory and the depreciation rules. You may have WTO income, your crypto has dropped in value and you still believe in it, but you can use the mark to market rules to not sell the crypto, but still use those losses against your other income. There are pros and cons to it, but it avoids the $3,000 limit, and it also avoids you actually selling the crypto. It also avoids the eventual wash sale rules that may be coming in. The only challenge is if you do end up with an ordinary income, which may be beneficial in some cases, talk to your accountant, you are no longer able to claim the capital gains special rate, where the capital gains, you could have up to $80,000 worth of capital gains and pay 0 in taxes. And capital, this is why wealth is taxed differently than income. So the mark to market is something I bring up, that if of the 20 so participants that we have today, if you are deemed to be in business of crypto or NFTs, mark to market is something that you may want to talk to your accountant to see if it may help you in booking some ordinary income or loss without necessarily selling your crypto or your NFTs at the end of the year. So we're at 148, Mike. This is all that I have for today's presentation. It's a brave new world, but it's no different than the Beanie Baby world or the Tulip Mania world. Any questions, anything you want to add in the last 10, 11 minutes?
It was a great description. Why don't we do this, Lauren? Why don't we just open it up for some questions?
Sure.
Just do a Q&A. So if anyone has questions, Lauren can unmute you. You can directly ask GB and me. If there's no questions, we can just conclude for the day, and we'll see you next week. I do have a presentation on small business contracting, GB.
Yes.
We could possibly go through that next week.
Absolutely.
Okay. So does anyone have any questions you'd like to ask of GB or me on topics, tax topics or accounting topics, or what we just talked about? If so, Lauren can unmute you up here and put in the Q&A. Or even the grants I mentioned earlier.
And just one thing I wanted to add, most of you may already know this, but because of the rising gas prices, IRS has increased the standard rate for the mileage deduction. So from January 1st to June 30th, it's the regular rate that they have promised, 57.5 cents. But starting July 1st for the remainder of the year, it's 61 or 62 cents and some change. So this is where, as you keep your mileage log, this is very important that this year, if you are guilty of not keeping a mileage log, keep it, because when you take the deduction on your tax return for next year, you will have to claim on the 2 different rates. You can't just say, well, I drove 10,000 miles and I'm going to take my deduction. It's a different rate. So you will have to allocate from January 1st to June 30th. What was my mileage? From July 1st to December 31st, what was my mileage? There will be 2 different rates. So your bookkeeping will need to be a little bit tighter. So keep that in mind, because this is another assertion that you will be making on your tax return.
Thank you. That's unusual for them to do a mid-year change.
Yes, very unusual, but hey, we're living in some rather unusual times.
Right. So we didn't see any questions come in. So GB, I'm going to wish you a good day. And you
Thank you, sir.
Oh, wait, one just popped in. So
perfect.
Can you do a quick reminder on where to adjust PPP forgiveness and the California relief grant on the S Corporation tax return?
It's not a quick one, and to show that, I'll have to have my PowerPoint, which I don't have right now. So it's
why don't you make an appointment with an SBDC advisor and we can answer that question.
Yes, correct.
Okay. So that's the only question that popped in. As always, we have SBDC advisors available to you, and you can contact us, and we will help you out to the best of our ability. That's what we're here for. All right. So with that, good day, everybody. And GB, I'll see you next week. We'll go over small business contracting.
Okay. Perfect. I look forward to your presentation. Take care. Bye, Lauren. Bye, Mike.